Thanks a lot. I have a daughter in college at Miami of Ohio, and trust me, she's not in class right now, so I'm very impressed that you're here, so I appreciate it. My name's Chuck Ball. What I'd like to do today is talk to you about the business that I'm in, but also I want to give you a lot of my personal experiences of why things have worked for me and what I think is important. And a couple things I'd like to do is ask me questions at any point. And if we spend 30 minutes in here or we spend 3 hours in here, it's all the same to me. So I don't really care. We can talk as long as you all want, or we can get to a pub. It doesn't matter. So. And ask me questions, I'll give you my views. But what I really want to talk about is both the business and why I've been able to achieve some success in my field. And I don't want to go too far because David's up here. And if I talk too much about my success, then he'll be back in Vero on Monday. So it's a double-edged sword. Okay. So let me see if I can work this. I can. All right. So this is a brief background on my bio. I went to the University of Florida between 1968 and 72 and graduated in undergraduate school in the business administration here. And I was mentioning earlier, when I went to school here, the school was bigger than the town. So when I come back up to Gainesville, it's like a different world for me. It's just so big, and the school is obviously bigger as well. But if you had the opportunity to go back in 1968 to 72 and somehow were able to access my grades, you see that I was a very, very solid C student, and pretty proud of it at the time. So, but it's going to develop a theme that I'm going to talk to you about. So I went from here, took a year off, went back. I grew up in West Palm Beach. Moved to West Palm Beach when I was in the 6th grade. At that time, my parents had got divorced. My father and my brother stayed in Ohio, which is where I was born. My mom, my sister, and I moved to West Palm. And went to junior high school there, last of elementary, and then came from high school up to the university here. And after my schooling here, I took a year off and worked for a year, traveled a bit, and then decided I wanted to get out of Florida. Florida, for a young kid back then, if you wanted to stay in Florida and work, you either went into the retail trade or the tourist trade, or you went into citrus, and neither one of those things seemed to appeal to me. So I moved up to Boston and went to business school up there for a year. And then after that, I went to work for Bank of Boston and worked for Bank of Boston for 15 years. And I started my career at Bank of Boston in the lending area. And in the lending area, I started my career at the bottom rung of this lending career. The bank had what they call the management training program, which I'm sure banks still have, which they would take graduate school students and undergrad students. Up there, a lot of kids from Harvard and different schools like that. They put them into their management training program, which was a fast track. I wasn't on the fast track. I was lucky to be on a track. So I went to work for the bank in what was called secured lending, and I was a field examiner. And when the loan officers would decide they wanted to make a privately held business a loan, they'd take collateral on that to secure their loan because there wasn't enough cash flow to pay it back, so it was a permanent loan. Well, I'd go out and check the books and records. And so I started going out to all these little businesses and talking to the owners and trying to understand their business. And I was really interested in that. It was a very good experience for me at the time. And the only thing I knew when I came out of school is I wanted to get a job in finance. And the main reason I wanted to get a job in finance is because at the University of Florida I failed accounting. The only class I ever failed here, which was great. But I did want to get a job in finance because I felt it was an interesting area, and out of that area I could go to a number of different areas. So I stayed up in Boston for a few years and then wanted to get back south. and the bank had a satellite office in Atlanta, Georgia, so I moved to Atlanta and began working my way up the career path there. And when I was in Atlanta, I was a vice president of lending, and now I would go out and I would make the decisions to recommend make a loan to a company, give the structure of the loan, and negotiate with the owner of the business. So I did that for a few years in Atlanta. I lived in Atlanta for 7 years. My kids were born in Atlanta. And then when they were quite small, one of the reasons why I wanted to join a bank was not only the finance side of life, but for my own personal case, I'd always been interested in living and working overseas. And that's why I chose a large bank. And it's something I want to talk to you all about, because I'm going to give you some of my experiences of what worked with me, and hopefully as you go through your careers you can think about some of these things. But if I was going to work overseas, I had to join a big institution that had overseas facilities. And even though when I walked in the door the first day at Bank of Boston, there was no chance in the world they were going to let me go overseas, at least it was out there as an opportunity. So after about, well, let me back up. So 2 things on that. I told the people I had lunch with. In my experience, the worst thing that I've ever done was look for my first job. It was a terrible experience. I don't know if it's better today. I hope it is, but it's terrible. You know, you go to see all these people, you have a lot of confidence in yourself, and everybody just keeps saying, we'll get back to you. So my advice, and I'm going to give you some advice, so, you know, you take it for what it's worth, is that have a lot of confidence in yourself. I mean, I knew that I could do that job, and I just kept telling them that I can do it, and they finally gave me a job. Okay, so I go to work for a year. I go in for my first performance appraisal, and I got this wheezy little boss. You know, he's about 5'3". And I sit down with him, and he goes, you know, Chuck, you're never going to go anywhere. You know, this is about as far as you're going to go. And I'm on the last rung. It's, you know, the ladder only goes up, and he's telling me I'm never going to get off the last rung. So I go home, tell my wife, you know, oh my God, you know, I at least thought I had some abilities, you know. But what I did is what I was like to talk to you all about. All I wanted to do when I got my first job was get on board. Just get in there, and if I get in there, I know, because I have confidence in myself, that I know what I want to do, that I can perform and I can do the job. So even though this guy who is my manager, in charge of 20 people, a year out of school, tells me I'm not going anywhere, I didn't believe it. I think this is just a little manager guy, you know. And so I got out of Boston pretty quick and moved to Atlanta and worked there for a period of time. And we had a small, what they called a loan production office, which is where we go out and we solicit new business. And we're on the lending side, and you know, we're working with the bank to get the credit approved, and working with the owner of the business to make sure, you know, we get his business and we have a working relationship. And I do that for about 7 years, and I go to my boss down there who's running the office and say, you know what, I think I can run this office. What are you going to do? He goes, I'm not going anywhere. You know, I love this job. This is my job. You know, if you want to run an office, you know, we better think about something else. So as I said, the Bank of Boston had an international facility, and so my wife and I sat down and talked, and there's never a good time if you're interested in going overseas. If you're waiting for that perfect moment in your career, it's not going to happen. You know, there's never a good time. When I did it, my kids were 2 and 3. You know, what do they remember? You know, not much when they were 2 and 3. Well, so you say, okay, well, let's wait till they're 15 and 16. Well, that's not perfect either. You got teenagers, which you'll go through in your life, which is different. So there's never a perfect time. So we decided to go ahead and take the plunge. And actually, the first job I got offered was a chief credit officer job for the branch in Sydney, Australia, which was a big job. But for personal reasons, another job came up in London, which was the slot below that slot. And for personal reasons, I decided to take the one in London. Once again, figuring, okay, I'll go to London. It's a good job. It's not really the job I want, but I get over there, work hard, see what happens. So I went over there and took that job, and about 2 or 3 years later, I got the job of being the managing director for the merchant bank there, which was in charge of their equity and mezzanine and secured lending facilities there. And in the UK, as opposed to here, it's a little bit different. If you're a lender here, you have to be very concerned about not being in control of the business, because then all the creditors will sue you. Over there, they're more relaxed about that. So you could literally do what GE first did here, of supply the whole side of the balance sheet from equity, mezzanine, debt. You know, you could do that over there. So it was a fun job. So then I'm working for the bank about 15 years, and the job's not too fun. You know, the marketplace is hammering you to death about do more for less, and the bank is hammering you to death about why are we doing this? You got to get that. You know, so I felt every night I went home, I felt like I was in a wedge, a vice, and just another day, and it just cranked tighter on my head because, as I said, I was in production. You know, and my job was to get loans at the end of the day, and if you know, you could pretty well see whether you were doing your job or not. And so the vice just kept tightening and tightening. And I'm about 40 years old now, and the light dawns on me that, you know, if I really like this business that I'm in, and I want to have some financial success, then I'm at the wrong side of this table, because I'm at a bank, and I'm lending all the money, and we're getting 2%, and the equity guys are putting up whatever they're putting up, and sometimes they lose it all, but sometimes they make a lot. So I decided to leave the bank and join an equity group that I met in London called Andlinger Company. And I moved from London to Brussels. And when my friends at the bank found out that I did that, they called me up and said, "You're crazy. I mean, why are you taking that risk?" And it's part of what I want to talk about today, because the essence of my job is assessing risk. When you cut through all the other crap that you talk about in my business, you know, it all boils down to that. What's the risk? How do you manage that risk? And what's the reward? My case, sitting where I was, the risk was staying with the bank. I mean, in 1990, the banks were in big trouble. The Fed was all over them for reserves, and they're making banks consolidate. If I'd stayed there 2 or 3 more years, I was well, probably 1 to 2 years. No doubt in my mind I'd been out on the street. So to me, the risk was staying there, not going. So I sat down and talked to my wife, and I said, "Look, you know, let's go do this. We'll move to Brussels. We don't know anybody, but what the hell? What's the worst that can happen? I can look at you and say, well, it seemed like a good idea at the time." And that's what we did. So after 15 years, I moved to Brussels and lived in Brussels. After 15 years with the Bank of Boston, I moved to Brussels, and I lived in Brussels for 3 years. So in total, I've lived in Europe for 7 years. So my job with Andlinger Company is to find businesses, to negotiate the sale of that business with the owners, to find financing for it, and to negotiate that agreement with a bank, to negotiate the documents of the sale, then to go on the board of the company, and then to eventually be involved in selling the business. Yeah.
Before you go to
Everybody call me Chuck. I'm old enough now, you know, that Mr. Ball makes me just feel more. All right.
Before you start to describe exactly what you do, can you talk a little bit about? I teach some classes here, and you've been very willing throughout your career to move, not just throughout the United States, but throughout the world. And a large fraction of the students that I teach, it's like they never want to leave Florida. And I'm not exactly sure what to tell them in terms of if they go into their careers or into their life with that mindset, how restrictive is that? So the typical thing is, people here consider the North Atlanta.
Yeah.
And the idea of going to San Francisco or Brussels, I mean, except for just a couple of people, is almost unheard of. And I don't have a very good sense of what to tell them about, well, yeah, okay, maybe you'll make a little less money, or no, you're really shutting out a lot of opportunities. I'm not sure what to say.
Well, part of what I want to talk about today is to give you my impression of areas of our country which I think we're strong in, and areas of our country which I think we're not so strong in, and how we're different than in my experience, Europeans. But I think we all have to have a sort of fundamental decision about what's important in life. And, is it quality of life, or is it, financial success, or is it this, or is it that? For me, for a long period of my life, and even today, I mean, the quality of my life was really important. My family was really important. I never did anything that I thought would jeopardize my family. But I do think one of our country's great advantages is a mobile workforce. And I'll give you an example of this. I was going to talk about it later, but I'll give you this now. When I lived in London, I went up to what they call the Midlands, and that's like the industrial center. And they have all these companies up there that they call metal bashers, which are, just little engineering companies that make widgets. This guy went up to this town, and it was probably 10,000 people, maybe 20,000 people, but a small little town. This guy's sales were probably 10 to 20 million, something like that. And he had two plants, one on the north part of town and one on the south part of town. He probably had 200 people at each plant. The plants were 7 miles apart. All right? Business was bad. This is back when Thatcher was PM, and they had all the coal strikes and all that stuff. I mean, it was where the UK really radically changed a lot of their thinking in business. Business was bad. So he said to his employees, look, I got to consolidate these two plants. They're 7 miles apart. I got 500 employees now. I can maybe have 100 of you come down to this plant that's south of town. What do you think? Everybody quit. They would not go to work 7 miles from where their job was. They gave up their job and went on what they call the dole, which is, welfare, rather than move those 7 miles. That is incredible to me. I mean, who would think about 7 miles in this country? As to your point, I don't have any jobs in Gainesville, but I got a lot of them in Chicago. I'm off to Chicago, And I think if you look at that and you think about our country, I mean, we've had a very mobile workforce, and that's a great strength. And I would encourage students to keep that, because it's a great experience. If that, you have, it's like an old bank robber said, Willie Sutton. Somebody asked him one time, why do you rob banks? He goes, well, that's where the money is, So, I mean, you have to go to where the jobs are. And depending upon what your job is, you may have to go. One of the questions I was asked at lunch is, why do you live in Vero Beach? You're in international private equity. I don't think Vero Beach is really a hub for that. And it's not. But I'm fortunate in my job because I can work anywhere I want to. For me to work, I need a phone, a fax, a computer, and an airport. That's it. That's the good thing about my job, for me, because it allows me to work in Vero Beach, have a lifestyle that I like. I grew up in Florida. I raised my kids now in Vero. And that worked for me. But if it's not going to work, then you're going to have to, I think, be flexible on where you go for your employment. certainly in the beginnings. You know, as you go forward, and like I did, I knew it was time to leave Boston when I walked outside one day, and it's in the springtime, and there's snow on the ground, and my wife, who grew up in Florida as well, is out there in a little, you know, chair. She's got her pants pulled up, and she's sitting in the sun like this, you know, in snow. Yeah, time to get to a better, you know, climate. So that's why I wanted to get back south and back to Atlanta. But if you join an organization that has different facilities, at least you have that option. And it's sort of what I talked about a minute ago about just get on board. I mean, yeah, maybe you don't want to go to Chicago, but you have to do that for a couple years, but they have some place in Miami or somewhere else. One of the things that you need to do is put yourself in the opportunity to succeed in your plan. And if you want to get to Miami, and the only way to do that is through Chicago, give yourself that opportunity. You may get to Chicago and find out, hey, it's not all that bad. But whatever you want to achieve in your business and personal life, you have to put yourself in a position to succeed. What it did for me when I left the bank and joined the Andlinger Company is it gave me a chance to succeed financially, because I was at a different seat at the table then. But until that point, no matter how good I was at the bank, I was never going to succeed in my plan because I didn't put myself in a position of opportunity. Now, once you get that opportunity, you're going to have to make the best of it, and I'm going to talk to you a little bit about what I think that takes. But you have to put yourself in that opportunity, and if you don't do that, it's very, very difficult. Okay, so here's one of the businesses that I bought for our company. This was about 1999. And Galileo was a NASDAQ-traded company. Had a market cap of around $20 million. And one of the things that we do as a partnership, which I'm a firm believer in, is we try to make investments where we can leverage our capital. And that's a key phrase for me, because I'm in the business of putting money out. And if I want to go to work in New York for a big firm, KKR, little, thousands of them. You know, there's thousands of them now. And the amount of capital in my business is billions. If I just want to put money out, I can put all our money out pretty quick, like in a day probably. But that's not what I want to do. What I want to do is leverage the capital of our partnership. And the capital of our partnership is two things. It's the money and the experience. And where we've been successful is where we've been able to do that, is to make that combination. And I want you all to think about your personal capital, because you all have it. Now, it may not be financial, but it's personal. And you all have it, and you all have something to bring to companies and to yourself. So in this case, it was a small NASDAQ-traded company. It actually was in women's health products and telecommunications. Okay. Didn't seem like a natural fit to us. But what it offered us is it was run by an engineer. And this engineer had bet the farm on coming out with a new way to distribute data. Don't ask me what it was. I mean, I could never understand it, and it never worked. But he just would not admit that he made a mistake. And he continued to plow money into that venture until the company was near bankruptcy. So much so that they couldn't make payroll and couldn't make their payroll taxes. But what we saw was an opportunity to restructure the business and change its directions, which we have a background in. part of the things we do is buy turnarounds, because the background of my partners, and now after 10 or 15 years, my experience is understanding how to operate business. Let me tell you something else about operating businesses. Most of your background will be financial. And when I worked for a bank, I used to walk into businesses and see this operating guy and think, God, is he smart? Wow. You know, I'm just a finance guy. I just know numbers and, you know, equations and current ratios and all this. But he's got operating experience. Well, 80% of running businesses is common sense. 80% of running business is common sense. But a lot of my partners had operating experience that we thought could help. There was a lot of assets in the business that my job was to go out and sell, to restructure the business. And that's what I did. And my boss, Gary Andlinger, I don't really call him, he is my boss and he isn't my boss. I mean, he's my partner. He had a background in public companies. So it was a natural fit for him to get involved in the public company side of life and for us to get involved in the operating side of life. And I will tell you that the skills of running a public company, of managing a public company, and managing the operations of a public company are totally different skill sets. You manage a public company, you spend most of your time, 80% of your time, is managing the public side of it. It's the investment community, it's the analysts, it's the, you know, the shows you got to go to. It's all that. He had that. He had a great success earlier in public companies, so that when we got involved in this, there were old investors that knew him, knew his name, came right into the company as shareholders. So after a couple years, you know, I sold off. I mean, they were in the night vision business, you know, made all the stuff they use in Iraq and all that stuff. I mean, it was just a giant mess. But we sold all that off, and we were left with the telecom side of life. Now, this is the late 90s. This is the late 90s when the internet thing is going like crazy. Business is going like crazy. So when we bought this business, we knew we had a short fuse, but I didn't know how long it was. But you know, this wave was not going to last forever. So we got into the telecommunication business, and we started making wafers that were used in telecommunications for the DWDMs, split the fiber optics, all that stuff. And we got the best guy in the world to run this plant. So we had the best guy in the world running the plant. We had Gary managing the public side of it, and me trying to sell everything off that wasn't bolted down to get cash to plow back into this side. So we bought the business, and the share price was $2. We had our first annual shareholder meeting a year later, and the shares were 100. So the shareholders...
all the equity outlined from the tender offer merger transaction? What was the...
Yeah, it was
public at the time, right?
It was public at the time, so the company needed cash, so we bought new shares, so we could put shares into the business to pay the bills. It was we owned 23%, which was control, but not a majority, and we controlled the board. You know, so the shareholders were pretty glad we showed up, and about 6 months later, Corning made us an offer that valued the business at $2 billion. $20 million to $2 billion. That's a hell of a ride. You know? Now, when we got into this business, did I see this? Of course. I didn't see this at all. You know, it wasn't important to me, truly. I mean, we were talking about this earlier. I'm sure everybody here can work a discounted cash flow model. And when we valued this business, how many of you think we did a discounted cash flow model?
With the starting point.
Never did. I don't think I could do one. You know, This is part of what I want to talk to you about, because it wasn't important. You know, what was important to make happen. And what was important to make happen, it was to save the business. And how much money did we need for that, and what would that equate to? We have never gone into a business because we thought we'd make a lot of money. It just truly isn't in our mindset. We go into a business that we think we can leverage our capital, and if we can leverage our capital, we tend to make a lot of money. So, as I said, Corning took the company over. Sad story after that, as you know, the thing popped, and but I'll tell you, I'll digress a minute. One of the worst meetings I ever had in my life was about 3 years later. A competitor to this business, an owner of this business, competitor called me up and said he wanted to talk to me. So I flew up to Boston, went out to see him, and he said, you know, you caused me a lot of trouble. And I went, well, I'm sorry, you know, what was it? And he goes, well, basically, you sold your business when you should have, and I didn't. And he said, you know, to me, what do you think my business is worth now? You know, I looked at the stuff and I said, not worth a lot. You know, so as a professional investor, you need to concentrate on buying a business, but you also need to concentrate on selling it. You know, we don't have family businesses. We're in this for capital gains, so that selling a business is as important to us as buying it. All right, so what are we going to talk about? A little bit about private equity, leveraged buyouts, a profile of Andlinger Company, investing in the international marketplace. I'm going to give you my suggestions on the next two items sort of go together, is how to get a deal done and what's important. Yeah.
Before you leave the Dell layout, how did you find that company? Do you have a sort of set search process?
No.
Or?
No. In the United States, there's this whole community of mergers and acquisitions that go from you know, the Wall Street firms to one guy in Ocala, Florida. You know, my job, as I said originally, was to go identify businesses to buy, and the way you do that is through the intermediary market of mergers and acquisitions. So you go talk to one guy who talks to another guy who talks to another guy, and a guy called me up that I hadn't talked to probably in 2 years from Boston. Said, I got this company, you know, that's losing money. And usually when you talk to an equity guy and somebody says, I want to talk to you about a business that's losing money, you get a dial tone. Because, you know, they want to have good business, they want to have good management, they want to have a good industry, they want to have a good balance sheet, they want to have a good this, good this, good that. We're not like that. You know, because we invest our own money, we have to sort of go around the elephants of the world. And so when a guy says to us, I want to talk to you about a business that's losing money, we go, sure, tell me about it. And in this case, we could see why it was losing money, and if a decision was made, it wouldn't take long to fix it. So that I found it through a broker. You know, you get the Wall Street guys, and then you have the independents. And this was an independent guy. He just knew about the business, knew it was in trouble, needed new help. So, okay. If this doesn't need covering, you know, we can skip it. So I don't know how much you know about private equity, about buyouts and things like that. But basically, private equity falls in two groups. It's buyouts and venture capital. It's development capital and venture capital. And typically, the way the capital goes in, it goes in first as a venture deal, and then as the company becomes more self-sustaining, then buyouts come along and provide development capital or liquidity for some of the owners. So Usually they're existing operating businesses that you have some track record of operations that you can take a look at and value. That's either a whole business or at times business segments, or especially from a larger company, they'll just sell off product lines or something like that. Either case. It can be leveraged, and they usually are leveraged, or it can be all equity. My boss started this business in 1976. He was one of the first companies or first people to do this in the States. And in 1976, he could put up $200,000 or $300,000 and go out and borrow $100 million. Seriously, $100 million. And it doesn't take too many right decisions, at 300,000 to get you in the black. But all that's changed now because much like a number of different areas in the United States, the private equity market today is very, very efficient. Very efficient. There's lots of firms, lots of capitals, lots of people doing deals. So it's very efficient, and it wasn't back then. And it wasn't for a period of time where we were able for a period of time to buy a business relatively cheap, improve the margins, and get a greater multiple on sale. Well, if you can do those three things, you're doing all right. Now you're not going to buy anything cheap. It's just not there because of the efficiency of the market today. Ventures is really seed capital, starting from scratch. I'm going to talk a little bit about a venture in a minute that we're involved in. Why are we involved in that? And what our partners do and see in that. So those are basically the two types.
Let me ask you a question while you're here. Over the years, we've had people coming in on Fridays. Great to have you because you're a different variety. It seems we've had private equity, VC really, and a fair amount of a lot of the private equity, all of them, I think, have been involved in the value adding in the deal. Is their ability to add value comes a lot from helping management, family-owned businesses obtain a liquidity event, exit a non-public business. But it sounds like it's fair to say from what you've described, you have a lot more turnaround kind of situations than liquidity events. Obviously, if they're public companies, that's not even the case. So, if that's fair as a generalization, then you're operating many times in a more hostile environment with existing management than certainly is the liquidity event. I mean, the guy that you described in that optics, was he happy to see you?
Yeah, he went away very quickly, but typically...
But not by himself. He didn't raise his hand to go away quickly.
No. Most of the turnarounds we've been involved with, we have found that management was fairly good, especially if it's a subsidiary of a big company, because they just weren't getting the support from the parent company that they needed. And it's not so much support, of money, it's just, let us go do this. And they just couldn't get that support. So
bad compensation, maybe lack of control rights and that sort of stuff.
Well, no, it's mainly on focusing on the business. If you go to a large company, and the large company is billions, I'm going to guess, even today, that budget gets rolled up from the top down. The business segment guy goes, I got to have this earnings from you and that, and then the guy that's running the business sat there going, well, this doesn't make sense. So it was just the communication that, especially in the 70s, that existed between subsidiary companies and head offices was terrible. Sure, it's better today, but it still exists. But most of the businesses that we have a core strength. Now, to digress, we bought a small business in South Florida, in the impact window and door business. So for hurricanes, instead of shutters, you'd get impact glass. In bankruptcy, been in bankruptcy, was part of a roll-up. Management was terrible. But we brought in management there, and we changed all the senior management. So there's no common theme. It's just it depends on what you get and what you can do about it. Okay.
A quick question before you move on, if you would. Before you said that 80% of running a business is kind of common sense.
Yeah.
And I guess I'd be interested in a couple of things. You just gave us, it sounds like, an example where there's a very good reason why common sense didn't prevail in these subsidiary type businesses, but then when you bring them private now, you've created an environment where you can impose some common sense. So I guess a couple questions I have. One, could you give us some other examples of some reasons why common sense isn't so common? And then maybe two, maybe some cases of, give us some, I'm not sure what you consider common sense is the same as what I consider common sense.
All right, so just to help, if there's, you talked about maybe the elegant term is hubris. There was the guy in Net Optics who was just took his eye or just got overly involved, and then there's the people that lose common sense because of the size of the organization they're involved in and the constraints that come
Okay.
from that side.
Let me tell you what I think is really important in business. And I'm going to jump around here a little bit.
Please.
And I'll come back to this one because I have a slide on how we deal with management. And the slide is more from a technical sense. But how we deal with management on an individual basis. And what's really important to us. And I think it's important to every business, and I think it's important to every organization, whether it's this business school, GM, or our portfolio companies. And it's focus on problems. A lot of my partners came from ITT. ITT is a big company. And ITT at the time had $2 billion of business in Europe. And one of my partners was in charge of all the operations of ITT in Europe. And he went over to he was living in Brussels. He went over to the UK. And he sat down with the managing director of a business in the UK that had $1 billion in sales. And he's sitting there, and the MD says to him, my partner Jim goes, how's things are going? And the MD goes, Jim, the biggest problem I have is inventory management, but I don't have time to deal with it. Now, my partner told me that 15 years, and I think about that every week. Because if you can't identify problems and work on them, you're not going to be successful. Everybody has problems. So what do we do when we go to a management team? We walk in the door, and I make two speeches. I make one for management and one for workers, for the direct line workers. And I tell management that I'm here, and we're going to talk once a month on a formal basis, but you call me whenever you want to. But we're going to have what we call operational review meetings, where we sit down and we go through the balance sheet and the P&L and the business and all that crap. And what we talk about is problems, because we think we can help guide the problems. And have you thought about this, or have you thought about that, or let's try this? Because if management doesn't focus on problems, they are not going to go away. The other true thing is a small problem is a hell of a lot easier to fix than a big problem. And you got that opportunity twice, so why not focus on it when it's small? To the extent that you go out in your careers and you can fix problems for a business, you'll be successful. And that's part of also what I want to talk about. I'm really jumping around now. Is don't be afraid of failure. Don't be afraid of it. Take a chance and try to fix something. To me, it's better than not trying, because it's not going to go away. So when I sit down with the management of a business, I tell them that I only have one rule with my relationship with that president or that management team. If you have a problem and you discuss it with me as a representative of the shareholders, It is our problem to solve. We will attempt to solve that problem together. If you have a problem and you don't tell me about it, and you call me up and you say, I got a crisis, that's your problem. That's not my problem, because you didn't share it with me. That's the only rule we have for managing the business and management. The other thing I do is I go down and talk to the workers and tell them things are going to be changed, and here's the way I want you to change. I don't want anybody in this company to work any harder. I don't want anybody working any harder. I want everybody in the company working smarter. I want everybody working smarter. So if you've been doing this one thing for 20 years, and you've been doing it this way, and you don't know why you're doing it that way, step back and think about it. Is there a better way to do it? And I don't want you working harder, faster, any of that stuff, but think about what you're doing. Because I've always believed that nobody knows his job better than the guy doing it. It's not some guy sitting up in the corner office, looking down at the factory at the assembly line. It's the guy putting the widget into the machine. Knows it better. So I want everybody to work smarter and not harder. So that's how I deal with managements and companies. Okay? Okay. Once again, I'm not sure how much you all know about this, but in a leveraged buyout, you buy the business for X and you secure the lending of it with the company's assets and or cash flow, and the bank is going to give you a percentage of each of them, or maybe only the assets, since the cash flow is more soft and cuddly and things like that. So as I said in the beginning, we could borrow hundreds of millions upon thousands, and today that's changed. So that if you had a purchase price of $18 million, you're probably going to have to put up $8 million, and borrow $10 million. It all depends on the company's assets and the company's business. And, as I said, if you boil down to what I do for my company, it's assessing risk. And it's perceived risk versus actual risk. And I'm going to give you an example of that later. And from a business point of view, we take a lot more risk than the average equity group because of our background.
I was just going to ask, do you have an ideal level, an ideal equity percentage in terms of the purchase price?
From our point of view?
Yeah.
The greatest deal is where you don't put up anything, but those days are long gone.
Is there a certain level, if you can't borrow enough to dismiss the deal?
Yeah, absolutely. We don't, as I said, we don't do a discounted cash flow, but if you're putting up 50% of the equity in the deal, and that company's going to grow maybe 2-3% a year, you're not going to, might as well leave your money in the bank for the risk you're taking.
Right.
So we tend, most deals now, there's so much money in this market. Everybody has $1 billion. You stop 3 guys on the street in New York, they got a fund of $1 billion, just on the street corner. And a lot of the deals today are putting up 50% equity. And for us, that's hard, But I'm going to give you an example where we did a venture deal, or we are doing a venture deal, where we're putting up all the money. But I'm going to describe the company to you, and to us, it fits our background, and the risk and reward is worth it. So there is no magic number. Companies go out of business when they run out of cash. It's the only reason they go out of business, is they run out of cash. So cash is the thing that we talk about and that's important to us. So when you structure a lending facility, you want to make sure that you have enough cash and working capital, because it's a nightmare when you don't. So, anything else?
It's all safe to say that I'll follow up on Peter's question, but obviously because trades are too opposed on cash flow, and and what the lenders are willing to do, which probably overlaps a lot, dictates the maximal amount of debt that you can take, and then that's not a lot of debt, then that lowers your leverage, your ability to return equity.
Right. But for us,
paucity of it at some point in time.
yeah. See, but for us, it makes it it hurts harder because it's our money. I mean, if I'm working for another capital firm and I've got $500 million, you know, and we're in the 4th year of a 5-year fund, what do I care if my return's 25 or 30? You know, do the deal, get it done, get it out. You know, we don't think like that. You know, as I said earlier, I mean, if we wanted to put our money out, it could all be gone by the end of the day. So we are very different than a lot of people, and it has to do with our background and investing our own money. I will tell you that you know, equity returns in the market today are, you know, in the 20s. You know, and for me, when I think about that and I think about the risks you're taking, that's not very attractive. You know, but that's the market today because there's so much money. Okay, so what is Andlinger Company really? As I said earlier, we're one of the earliest firms to participate in the leveraged buyout market, and that was because of the background of our founder, Gary Andlinger, who is Austrian. He's a U.S. citizen now, but was born in Austria. And I want to take a minute to describe his story. Gary was 16 years old after the war, and the International Herald Tribune, which is a U.S. paper, the combination of Times and the Post, ran a contest for high school kids in Europe about what should the vision of Europe be. Gary won it for the Austrian male category. And their prize was to come to the United States and travel around the United States and spend 60 days with families, individual families, and learn about the United States. So here's a 16-year-old kid coming from war-torn Europe to here. You know, obviously fell in love with it. Went back and applied to schools and got accepted in Princeton. But the bad news, the good news was he got a scholarship offered at Princeton. The bad news is he had no money to get there. So at the time he was working for the U.S. Army in Austria, and the Army actually smuggled him onto one of their cargo flights back. So Gary shows up in New York City with $7 in his pocket, gets down to Princeton, gets admitted as a junior, works his way through Princeton, goes on to Harvard Business School, then goes on for ITT. He worked for ITT for 20 years, and I worked for Gary for 15 years, and I don't know now whether he was fired twice from ITT and quit once, or quit twice and was fired once. But it was this deal with him and a guy named Harold Janine, who was the guy, he was the Wall Street guy, Janine was, and when he was building up ITT, he'd buy all these businesses and then tell Gary to go run them. So finally in '76, he went out on his own and began to acquire businesses. And over that period of time, between our offices in New York and Brussels, in Vienna and Florida, we've acquired over 100 businesses. And we have 18 principals. All of us have worked overseas. Half of my partners are Europeans. And that is a fundamental background to our firm. And when I talk about leveraging our capital, that's what I'm talking about, is we like businesses that are international. The company that I told you about earlier, Galileo, that morphed into Net Optics, when we were changing that business into telecom, it had a facility outside of Boston, but we immediately set up a facility in Germany. So here's a company with maybe $1 million in sales, or maybe less. We've already got it situated for growth in Germany. Not too many investors would do that. You know, not too many investors would do that. But that's a background of ours, and we're very comfortable with that. Very comfortable with it. So that's a bit of the background on us. Each partner, when we do a deal,
You said it's refer to using your own money. It's a partnership, so there's no.
we use that term loosely. We operate as a partnership, but actually Andlinger Company, it's Andlinger Company Inc. And Andlinger Company Inc. really just owns the furniture and the chairs and stuff like that. But when we go to buy a business, we all get an opportunity to invest, and we all put up our own money when we do invest. So everybody gets a piece of the pie. It's different because if I'm working on it, I'm going to get a bigger slice than the person in Europe because he's working on something else. He's going to get a bigger slice of that. But we all participate in every transaction. Yeah. Transatlantic, I touched on that of our background mainly in Europe, but also in other countries. And most of my partners have had operating experience. We were talking about this at lunch, and we don't. I don't think we've ever hired a kid out of college, and so we haven't probably hired anybody in 5 years. So as a potential employer, we're probably not your best hope. But after I've been with them 15 years. I think I understand pretty much about operations. So at this stage in my life, I'd consider that I have operating experience.
This kind of goes back to the last slide. I know you said you've acquired 100 companies. How many portfolio companies do you have now? Approximately.
We probably have, I'm going to guess, 10 to 15 in number. And those companies would range from 0 revenues to around $1 billion.
Can you have a general target holding period?
No.
Very good.
Yeah. And that's a good thing about not having a fund is you don't have to worry about coming to the end of it and having to make some realization so you get your returns so you can go out and raise some more money. We looked at raising money a couple times, but it's sort of like getting your first job. It sucks. You know, you spend a year on the road begging, groveling, give us your money, please. I can do it. Forget it. We didn't do it. So what we do, we do buyouts and turnarounds. There are areas that we do like, and there's areas we don't like. We like manufacturing businesses, and we don't particularly like real estate. Because in a manufacturing business, we're afforded different operating strategies that we can implement given how the business is doing. Basically, real estate, you got land, and if the market is bad, you sit on it. So we like businesses with assets in manufacturing and distribution. We're pretty selective in the service business because our view on that is your assets go home every night. And you just hope they come back. So that's a tougher one. And we do selected ventures, which I will talk to you about one. Okay, so our philosophy is we are controlled investors. We broke that rule once, and it was a nightmare. I mean, one of the things that's critical for success in our business is to get everybody's interests aligned in the same direction. And it's pretty easy to do if we're the only ones in the deal, which is generally speaking, we're the only equity partner. And that's really important to us to have that. And I'll give you an example of how that is not always the same case. When I lived in Brussels, I used to get up every Monday and either go to Italy or go to Spain, come back Friday. And we owned businesses in both countries. and we owned a business in Italy that wasn't doing very well. And we were down there with a meeting with the management, and we said, okay, well, I understand the problem, but why don't we go and try this? And they said, no, we don't want to do that. We don't have to do that. And we said, well, wait a minute. What do you mean you don't have to do that? I think as shareholders and controllers of the board, we ought to do that. They wouldn't do it. They said they didn't work for the shareholders and the board. They worked for the company. Well, that was pretty interesting. So we, spent about 2 months fighting with them, and the company continues to go down. But it was a misalignment of the interests. And when you get a misalignment of the interests in a business, it's a problem. Whether it's with your management, your shareholders, your investors, it's a problem, and you better deal with it quick, because it's a nightmare if you don't. We invest our personal funds. As I said earlier, we really try to focus on opportunities where we can leverage our capital. And to us, and to me, it's our background in the international area, especially in Europe, where we can help a company try to accelerate their growth. A long time ago, we owned these businesses in Belgium that were in the industrial laundry equipment making business. We owned 3 of them there. And we owned them for about 3 or 4 years and decided to sell them. In the meantime, I had found a business here in the United States that was in that industry. So I thought it was a pretty good idea for us to buy it. So I went to my partner, I went to Gary and discussed it. And he said, yeah, that's a pretty good idea. Let's talk to my partner in Brussels about it. Well, he thought it was the dumbest thing he'd ever heard of, and said, no, we shouldn't do that. So a couple months go on, and I'm still thinking, that's a good idea. We ought to do that. So I go back to Gary. We talk to him. We finally end up buying this business. So we try to sell these businesses in Europe. They're good businesses, good businesses, making nice margins, growth plan. We can't find anybody to buy them. I mean, we had this party, and nobody showed up. So finally, Citicorp came to us and said, we really like this business, but it's a little bit small. You got anything else in there? And we said, yeah, we happen to have this business in the States. Their faces lit up. They loved it. They bought the business. So we try to buy businesses like that where you have manufacturing in multiple countries or distribution in multiple countries. When we went to Europe in 1985, I guess, the European business community is very different than we are here in that you have some large public companies and you have numerous small private companies. You have numerous companies between 10 to 25 million in sales and very few private companies from 25 to 150 in sales. So if you're a small company in Europe doing 10 or 20 million, by definition you're in the export market because you're exporting to different countries in Europe and elsewhere. So it was important for us when we did these things is to try to cluster businesses into a industry like what I just described, where now we've got a company that's doing maybe 80 million in sales, so that when their sales force goes off to Indonesia, they got a broader product line, and that's a more cost-effective selling process than just three $20 million companies in Europe and a $20 million company here in the States. So that's the type of guidance and background that we try to add to these businesses.
I've got a question for you.
Sure.
Maybe in 2 parts. So I like a lot about this model as I hear it, and it just maybe from an economics 101, people make money when there's barriers to entry. And you've gone through several scenarios. You have value being added by doing strategies across countries and recognizing things that I can imagine somebody who was focused on a particular country would obviously miss things. Do you think that there are significant barriers to entry in your strategy because of the getting to understand the culture of the business operation?
Oh, absolutely.
And then secondly, related to that is, what happened in creating a European common market and a common currency. Is that cleared out some of the barriers to entry for you? Is it easier for people that to spot these things because they're all knowing where I'm going?
No. Even though Europe works under a common currency, they are still separate countries. And why I think we can help companies that want to get involved in the international marketplace is because my partners are Europeans and different nationalities. We can add value that gives that company that subtlety of being local. And there's nothing that can replace that.
I like that.
You know, nothing that can replace that. And you know, to the extent where we went down to Italy as Americans, we got our ass handed to us. You know.
Now, interestingly, on the financing side, have you found that there's a little better appetite for getting debt financing with the common currency because people can hedge it and the risks in the banks, things like that?
No, the Europeans by nature are more conservative than we are, and that's a reflection in their banks as well. So if you look at an average capital structure here of, pick some numbers, 35%, 65, you know, 40, 60, whatever it is here, the same dynamics would be a more conservative capital structure there.
But I've heard people say this, that you might get better banking terms with the common currency because if you have this small Italian firm, you're going to borrow lira denominated, you know, or some currency that's sizable, but not where there's active markets in that currency. And now with the global currency, maybe a German bank or an Austrian bank or some other bank might be interested because they're going to borrow in euros. But
I don't think so.
They're not going to go to a small business.
No, I think it would be hard-pressed for a German to feel comfortable lending money to a small Italian company. You know? I just don't think that's going to happen.
So that,
you know, regardless of the
those
currency.
haven't changed. They're still
No.
rely on local sources of capital, and they're still very local in their mindset.
Yeah, I mean, as in the banking community here, those facilities are consolidating, so you have mergers of a German bank and a Spanish bank, you know, to get more assets and to, you know, decrease the cost of the back operation. But the Spanish bank is still going to be most effective in the local market. Anything else? All right, we as I said, we take a long-term view, and it's a personal view. And when we decide to sell, we've never decided to sell a business that management hasn't agreed with us. And typically, we look for management to make that decision and come to us and say, either from a personal point of view or from a business point of view. And that's a great thing about us is we're able to do that. Well, I've actually had some partners that have wanted to retire and wanted to get out of the business, so we sold a couple of businesses that they had interest in. So, and we do like to foster entrepreneurship, and I'm going to talk about that a little bit later. Okay, how we work with management. Typically, we put up the money for the management to buy their shares because they usually don't have any money. But we do like for them to have some money in the operation, some money in the facility. So, you know, if we put up $6 million and management gets 10%, they got to come up with $600,000. Maybe they don't come up with $600,000, but they're not going to come up with zero. They're going to come up with 100 or something. So, as we say, they got some skin in the game.
How often do you replace management upon purchase?
We rarely replace the management team. We usually will replace a portion of it. It's been our experience in privately held businesses that are, let's say, $20 million in sales that have been owned by an entrepreneur or a family. And as I said earlier, about working smarter. Those businesses have done the same thing the same way for years. And some of those things are good, but some of them are not so good. But when you've had the same ownership and the same management for that period of time, they really don't know if there's better. So what we try to do is take a look at those different functions, whether they're the operating function in the plant or sales and marketing or accounting, and try to look to see whether there's an area that we can augment with either people we know, or we sit down and talk with the president and say, we think we got to beef this up. But there's really no hard and fast rule on that. So we put up the money for them, and typically the way we work with management is they get options. So let's go back to our 10%. What we would do is structure their option package over 3 years. So they get a third up front, and then the next 2 years is based on meeting their operating budget, which we sit down with at the beginning of the year and approve. So that they have to earn those shares by performance. Then at the end, as I said, typically that's between 10 and 20% of the equity in a business. And when I'm talking to management teams and they ask me, well, what kind of investor are you? My answer to that is that we are active board of directors. I go on the board of every business that I buy for our company. And we're an active board of directors, but we're an active board of directors more from the point of view of strategy and problems. My partners have run businesses. I've been involved in businesses where I've been pretty much running them. I don't want to run a business. We don't want to run a business. We want management to run a business, and we'll be on the board. But we're not the type of board that goes away for 3 months and comes back and says, how are things doing? So we're fairly active from the board point of view. We interface with management formally on a monthly basis where we, as I said, we have this, what we refer to as operational reviews, where we literally take the financial statements, the balance sheet, the cash flow, and the P&L, and discuss the issues and the problems associated there. And that takes usually a day with our management. We do that with every company.
Chuck, before you move on, can you talk a little about how you size up management and what you want? And you told us a little bit about the relationship between you and them, but do you want the managers? Do you want to be their friend?
No.
Do you want them afraid of you?
No.
What kind of a relationship do you want with management?
I want to be their business partner. I want them to feel comfortable enough with me that they can discuss problems. That, if they bring a problem to me, that I don't go ballistic, That's the relationship that I want. As I said earlier, we don't want our management teams to keep anything from us because, as I said earlier, everything has problems, and you got to deal with the problems. And that's the way we deal with our management teams. And as long as they are effective in dealing with the problems and ethical, then they'll be fine. Ethical is a big issue for us. I mentioned I own this. I don't. We own this window and door business in South Florida that makes hurricane glass, impact glass. It was losing money, and we bought into it. And I told the president, I said, look, I would rather have this business fail than ever have to face somebody that bought our product where we did sort of a bait and switch, where they thought they bought impact glass, and we sold them regular glass, and now the storm has come through and it's destroyed their house. Not worth it to me. For one time that happened, if it takes that to make the business successful, we're out of business. Just not worth it.
Moving along with what you look for in management, do you have any kind of Have you ever in the past taken a CEO from one of your previous portfolio companies and moved them into a
Mhm.
new company?
Yeah.
Is there kind of a pool of
I would.
managers that you have out there, a network of managers that you like to pull in if you're in a certain situation?
And I wouldn't call it a pool. No, there's not a pool, but we have done that on a temporary basis until we can get someone permanent. And we do have friends of our firm who have experience, so that if we're having a particular problem, we may say, like in South Florida, would you mind spending a day in the factory and tell me what you think, or a day with the sales and marketing? But within our organization, of investors, we have different background in different disciplines. So if a company is having difficulty in sales and marketing, I've got some partners who have that as a background. So they'll spend some time with them. But it's on a temporary basis. We don't want to manage businesses. It's not what we want to do in our life. So why do we do it? Because the business community is global. It's every company is affected by it. The opportunities are greater for us outside the U.S. because of the market in Europe for buyouts is not as big and as efficient as it is here. That our Vienna office, being quite small, is still the premier office and buyout fund in Austria. That's mainly because there's nobody else there, But it's a good opportunity for us because, with us being a small group and investing our money, we just can't go head to head with the big guys in New York or Chicago or San Francisco or wherever. It just doesn't make sense for what we're trying to do. So why? Let me give you some impressions of Europe. I gave you that one impression of the company that had the employees that wouldn't go 7 miles. We've had companies in Europe that look at our economy and just absolutely drool because it's so big and there's so much potential that they can't wait to get here. And so they bring their products over here and establish a sales office or a warehouse and things like that. And they can't stand it because the American consumer, whether it's a retail consumer or a business consumer, is so demanding compared to the rest of the world that it drives them crazy. It just drives them crazy. We want it on time, the quantity that we delivered, the color that we want, and don't give me any of your bullshit why it's a day late. Well, if you ship something a day late in Europe, you're ahead of schedule. It's just different, and it drives them nuts. There's a huge golden field on the other side of the ocean, and when you get there, wow, what did I get into? So it's different. I'll give you another thing to think about, which really dawned on me when I lived in Europe. If you picture the map of Europe in your mind, and everybody always talks about America, oh, you're so young, you're so young, all that. Well, consider it from this point of view. Look at the map of Europe and think in your mind, what countries are older than we are from a political sense? Not Italy. They had a king right before the war. Not Germany. Not France. Their revolution was after ours. Not Belgium. They're still fighting. Not France. They had Franco. Keep going down. Not many countries have a political stability that we do. And that really does impact business. So when they say, oh, you're young and all that, depends. To me, what's important is not how old the buildings are, it's how old are the infrastructures that are there that helps commerce. And from that point of view, we're pretty old. Now we're going to get into sort of the subjective nature. Do you want something?
What do you think the LBO opportunity in developing countries like China or in some Asian countries rather than Europe? That's too risky?
Well, let me. I'm going to give you some impressions that I have of our country strengths and weaknesses. And I think one of the fundamental values that we have that helps our business community is the entrepreneurial spirit. That people in this country are willing to take risk. Much more so than other countries. People in this country are, even today, in today's climate, are much more positive about the opportunities in the future than other countries. So if you take a look at a culture like Japan or other Eastern cultures, they're much more conservative than we are. So to go in there with this radical finance idea, I don't know. Maybe not. And we found that in Europe. We got a backlash when we went to Italy and started doing leverage buyouts in Italy. I mean, we got a backlash from the state saying, you're not going to do that thing in our country. So there wasn't this fostering community of, well, let's see what this is about. Let's try to do it. It was a roadblock. So do I think it's possible? Yes. Is it harder? Yes. I would say so. Yeah.
What you need to do to counter those difficulties?
I don't know. Just sort of one day at a time. You're not gonna get a bank to convince yourself that their loan is secured on the assets and they're not going to get attacked. I'll digress again. When we went to Italy, we were the first people to do this. And when we go down and buy a business in Italy, we'd sit down with the owner and say, okay, let me see the books. He'd show us the books. And we'd say, okay, show me the black records. All right? Because every company in Italy had business operations off the books. Still do today. It's a fact of life. In Europe as well. So we would go and sit down with him, and we'd value the business, and we'd pay him, and he'd go away. And we'd go in there, and we'd say the first thing to the people running the business, everything's on the books. If you got to pay the employees more because you're not paying them cash on Friday, we're going to pay them more because we're not going to run businesses that way. It gets back to our ethics. So we go down to Italy, and we buy these businesses, and some of them didn't work out as well. And the Italian government then sues us, sues me personally, criminally, for leverage buyouts in Italy. So now I'm not going to Italy, I'll tell you that.
Under what basis that you had destroyed value?
No. They said that we presented false financial statements. False financial statements in Italy? Is this for real? It was for real. But their point of view was we presented false financial statements because we had deducted the interest expense of the loan, and they said, you can't do that here. Well, if you can't do that, why do it? So we got in this big fight with them. It lasted about 4 or 5 years, and they finally dismissed the suit, so I can go back to Italy now. But it was so bizarre, Tell me again what's the charge? False figures. What a non sequitur that was. Yeah. I'm coming to that. Okay. So it fits our background in Europe, and we're very comfortable there. Okay. So how do you get a deal done? This first point is what I do. It's what I do for a living. Is I assess risk, and to me, when I do that, there's a difference between perceived risk and actual risk. And I was talking earlier about leaving Bank of Boston when I did, and all of my friends called me up and said, "You're crazy. You know, why are you taking that risk?" And to me, the risk was staying. And it was a difference between perceived risk and actual risk. I'll give you an example of that. What we do, we try to leverage our capital. And I'm sitting in Vero Beach a few years ago, and the guy calls me up and says, "You know, I got a business plan I'd like to send to you." Okay, fine. So he sends me a business plan, and I read this business plan 4 times, and I don't understand it. So I call him up and say, "You know, this is fascinating, but I don't understand. I want you to come down and tell me about this." This business was started by literally, you know, I joke a lot in my business about, well, it's not rocket science. Well, this business, there's a company in Melbourne that was started by rocket scientists, you know, serious rocket scientists. But their business is starting businesses. That's all they do is start businesses. And they have a very interesting philosophy on starting business. And it is that if you build a better mousetrap, you're going to get killed. Because if you build a slightly lighter laptop or a slightly faster laptop, you may have 2 years, but IBM's going to crush you. You know? So if you want to really build a big business, you've got to do something disruptive. And IBM is not going to do anything disruptive to their business. They're going to go in incremental steps. And if you want to disrupt the computer business, you better come out with something that's radically different. All right? So that's their business. So they came to us with this business that is in the greenhouse gas business. What the hell is that, you know? This company is involved in mitigating the emissions of greenhouse gases. Now, we got involved in this 2 years ago, where we took roughly half of the business. And 2 years ago, this market was certainly evolving. It's new. Nobody knows what's in store. But for us, the biggest risk we had that we saw in this business was how long before this business takes off. If you go back to what I was talking about at Galileo and the Internet, I mean, we knew that ride was not going to go on forever, but I couldn't tell you when it was going to stop. So our focus there was to restructure the business, develop this telecommunication business, and move on. The biggest risk we have in this business is, when does the market catch up to us? So what does this business do? It is the most fascinating business I've ever been involved in. 23% of the world's greenhouse emissions are caused by agriculture. Go figure. You know, everybody talks about transportation. Just as big. Just as big. You know. And within agriculture, there is what in the protein production side of life. That's a nice way of saying when you produce meat, pork, chickens in the United States, and that program has been exported globally to China and to Japan and elsewhere, the manufacture of them. So you have these massive farms where the animals are confined. And those animals emit a lot of manure. That manure contains methane. That methane goes up in the atmosphere. Methane is 23 times worse than carbon monoxide for greenhouse gases. So these guys, along with our government, there's a thing called a CRADA, where if you go to the government and say, hey, I got a good idea, they'll help you develop this idea and then split the royalties with you. So they, basically what they did is scientifically based through logarithms that if you mitigate this emission by covering it and then flaring it, you can calculate how much you saved going up into the air. So they started the business in the United States and signed up all these big firms like Smithfield and all this, and had all these relationships. Well, the unfortunate part about that is that the government didn't progress this idea. The government said, no, I don't like that Kyoto thing, we're not going to do it, and by the way, we'll do a voluntary standard, so just do the best you can. The rest of the world said, wait a minute, we think this is pretty serious stuff, and we're going to do something about it. But when we got into this, we weren't positive that was going to happen. So our risk was managing the business and containing the burn rate until the business developed. So they did this in the United States and in Canada. So we had all this agreements with the farmers. But the business model was fascinating because they didn't buy the emissions from the farmers. So the business had no inventory. So you took no inventory risk. We pay for the emissions when we sell it to the farmer. Furthermore, our agreement with the farmers is that we will pay them a percentage of the sales price. Wait a minute. You're telling me you got a business that you can start, that you don't have to invest in inventory. You have a totally variable cost of goods. I'm getting interested in this thing. What about fixed assets? You don't need them. It is the science, and it's the mechanism for monitoring these emissions that is the value of the business. And that's computers and a few people. So we go along, we do this in the United States, and in the meantime, Europe, with the United States backing out of this area, decides, prior to the Kyoto Accords being ratified, that in Europe they're going to make their own laws, European laws, and we are going to mirror the Kyoto Agreement. So that the Kyoto Agreement never comes into effect, who cares? We're going to do this. We're going to reduce our emissions, starting in 2005. So now we've got an end date, 2005. Oh, great. So we continue to run the business, and Russia ratifies the Kyoto Agreement. So now this is international law. So all the countries that have signed that now have to come in compliance with these greenhouse gases starting in 2008. So how do you reduce the emissions for greenhouse gases? Well, you can convert electricity, you can build forest, you can do all these things, and those are years to get to market. Years, 2, 3, 4 years. In this facility and in this business, we can begin to reduce greenhouse gases in 45 days. So our competitors are years, we're 45 days. Pretty interesting. The other thing is that this business is repeatable. First thing we did when we saw the United States was not going to take the lead in this, is we said, all right, Europe is, where will Europe buy these credits from? And the answer to that was, in the parlance of the Kyoto Accord, from CDM countries, developing countries. So we went to Brazil and started signing up farm systems there and converting their management practices. Mexico, Chile, those are the countries we're in now. In 2004, we had no sales. In 2005 and 2006, our production sold out. When we sell a credit in the future, you sell it on a stream, so many tons for '05, so many tons for '06, and so many tons for '07. We're sold out now. So all we can convert and mitigate, we've already had customers for. So our business plan now is to go from 0 to 10 in '05, to 50 in '06, and 100 in '07. I've spent the last 3 weeks in London talking to investment banks there, and we're taking this public right now in London. And they're talking about an initial valuation of more than $300 million. So why do I tell you all that? That's what I do. That's assessing the risk. What was the risk and the reward in this opportunity for us? The risk was time. This market is going to come to us. How long is it going to take? Well, you're not building a factory. You're not building inventory. You don't have to have a lot of people. You have to have some. So, I mean, the risk was the burn rate, and we could manage that. You know, we could hunker down until we saw these things start to develop. So that's what I do. You know, what's the risk and what's the reward? Okay, understand what's important. You think about what's important in a deal. You know, we talked about this earlier, you know, the discounted cash flow and all that stuff. That's nice to have, but it's not a have-to-have. What's really important in a deal to me is what's important in being successful in business. And that's understanding what's important to the other people in the transaction. When I talk to a guy selling a business, I really want to understand what's important to him. Money's one of them. It may be the most, but it may not be. So you got to understand what's important, and you got to work on solving that. When I'm talking to a business owner, there's two things I'm going to do. I'm going to tell him, if I really believe, and I'm not a good liar, if I really believe we're going to buy that business, I'm going to tell him, we're going to buy your business, and we're going to get this thing done. You got to trust me on that. Well, why is he going to trust me? Because during this process, I'm going to keep my commitments. And I don't care how small those commitments are. If I tell them, I'll call you back at 3 o'clock because I'll have an answer, I'll call them back at 3 o'clock. I'll tell them I don't have an answer, but I'm going to keep that commitment because nobody is going to put something so important as selling their business in your hands if they don't think you're going to do it. Nobody. So it's important for you, when you are in your career and decide what you want to do, be confident that you can do it. I mean, you know you can do it. Even if you have a short little boss. You know? Usually people don't get into situations that they're in over their heads. They understand what I can do and what I'm confident in. And keep your commitments. You know, if you're dealing with customers, or if you're dealing with your fellow employees, if you say you're going to do something, get it done, or tell them why you haven't got it done. You've got to build that trust. And that trust is the most important thing it is to get a deal done. Focus. When I'm in the middle of something, like this thing I just described to you all, I don't do anything else. I don't think about anything else. I don't do anything else. I'm completely focused on that objective. And right now, our firm, 4 of us, is completely focused with getting this company in the public arena over the next 90 days. I don't care about anything else. Don't talk to me about anything else. The greatest opportunity in the world could come right by me and I wouldn't even think about it. Because I can't take my eye off the ball of getting something done that's very important. I cannot be distracted on that. There is nothing more important to me right now than that. This is for my business. Be a good fisherman. What the hell does that mean? In my business, you can have a pretty good life. You can make a pretty good salary, stay in pretty nice hotels, fly around the country, around the world, first class or coach. Not too bad. But that's not my job. My job is to buy businesses. So when I have these business plans that are for sale, written by the investment banks, I have to know pretty quickly whether that deal is going to get done with us or not. Because I can spend a lot of time staying in nice hotels, flying around the country, and not ever get anything done. And in our business, if you don't get anything done, you're not going to make any money. We don't have any 401ks, and we don't have any pension plans, and we don't have any of this other crap. So at the end of the day, if you go around and you stay at the Four Seasons in New York and go out to San Francisco, and you have a great time, that's what you like, fine, you got a job in this industry. But that's not what it is for me. You know? Not what it is for me. So I keep telling my partners, be a good fisherman. When you get a hook on the line, get it out of the water and look at it and decide whether it's a keeper or throw it back and move on. And that is so hard to do. So hard to do. All right, David, you got to not listen to this part. But one of the things that financial security has given me is the ability to really focus on what's important and not do all the other shit. I said when I started today, we can spend a half hour here or 3 hours. And I'm willing to do as long as it's important. But I don't want to stay here for 2 hours exactly because that's what it says. It's crazy to me. You know? Do the job, focus on it, and if I can get the job done in 10 minutes, that's all I do. I go home. If I got something really important to do and I get it done, what does it matter how long it takes? So you got to really understand what you're doing and spend your time on stuff that's going to be important. And forget all that other crap. You're going to have to do it in the beginning. Trust me, I did it. But at some point, think about problems and fixing them and focus on what's important. Okay. So, what do I think? The first 2 points are sort of the same to me. You're sitting here, you're young, you're trying to start a career. I mean, how in the hell do I do this? I mean, geez, what do I do? I'll tell you what I did, and it worked for me, is when I got out of school, I knew I wanted to get into the financial side of industry because I felt that would give me a broad range of looking at different things and figuring out where I wanted to go. Did I have a planned career path? No. Never have. Never did. But by the same token, I put myself in positions to succeed in the path that I wanted to get to. You know, when I got into lending, I got out of being a field auditor and got into lending. And then I got out of lending and I went into the merchant bank. And then I got out of the merchant bank and I got into equity. Now, did I know when I was 25, how old are the kids? 24, 25? 24, 25, that I wanted to get in equity? Didn't have a clue. Maybe didn't even know what it was. But I put myself in a position to allow you to succeed. This next point is the biggest point I'd make to you. Go back to what I was talking about earlier, and that is you can join the private equity industry and have a great life. Make good money, you know, upper income money, stay in nice places. But if that's really what you want to do, that's okay. It's not what I want to do. I don't want to be part of the 80% of the workforce that just sort of goes along. I want to be the 20% that steps out and says, I'll take this risk. I mean, I take this risk. I'll tell my partners that we should buy this business so that if this business goes broke, they know who said that. It was me. And I bought businesses that have gone broke. Not every business that I put up there had those results. But what happens when you make a mistake? Think about it. What's the most important thing you can learn? I'll tell you what I think. How do you make decisions? Nothing is more important than that, in my belief, in business or in personal life. How do you make decisions? Think about that. How did I make decisions? What decisions did I make when I bought a business that went bust versus one that returned 100 times our capital? What decisions did I make different? I mean, what do I learn by that? Don't be afraid of making mistakes. Take the risk to get out there and be accountable for your work and your action, and learn from your mistakes. That's what I have.
We have other questions?
Okay.
Going back to your business, have you ever taken control of companies through their debt? I know you do
No.
turnarounds. You've never done that?
No, because the number is so big, you have to buy like $100 million of debt to get it converted into equity. No, I mean the numbers are too big.
Sometimes in bankruptcy.
You can, but the numbers are still. I mean, whatever debt it is, it's a massive amount.
Right.
So no, we don't do that. There's firms that do only that only take positions in distressed debt. A long time ago, those firms used to be called vulture funds. It's probably not politically correct today, but that's what they were known as.
I guess my only other question is how much exposure do you have to other buyout firms, either as competitors bidding for a deal or someone to buy a company from, someone to sell something to, or someone to invest with?
We rarely co-invest with anybody else because what we do is so different. I can't imagine another buyout firm in the world would have been interested in this greenhouse gas business. What interests us, is the international aspect of it. Here's a startup company that's starting up facilities in Brazil, and your customers are in Europe. I don't want any other. I don't want to explain that each month to somebody new. So we tend not to do anything with anybody else. We tend not to see a lot of other investors because, once again, if we're looking at a deal that 12 other investment companies are looking at, we're not going to get there on price, and we're not going to get there on the amount of equity. So that goes back to my point earlier about being a good fisherman. Throw it out. Throw it back in the pond, move on, do something that's going to be productive. Anything else? Yeah.
When you find a business and you're trying to determine whether or not you want to actually purchase it, you said you don't use the discounted cash flow approach or like any type of initial evaluation approach. How do you decide how much you're willing to pay for it?
Okay. What we do spend a lot of time on is projections. We spend a lot of time looking at projections and the sensitivity of those projections. What if gross profit changes? What if the sales only go up by 2%, not 7%? Whole bunch of sensitivities to the P&L. We do spend a lot of time on that. But we do not focus on what's the IRR in this opportunity. We have never looked at, let's say we got, as a partnership, $5 million to invest. And we got 2 deals that we have to consider, each of which take $5 million of equity. We would never make that decision because somebody said, well, yeah, but our IRR is 40% here and it's 20% there. Wouldn't do it. Couldn't care less about it. Seriously. Seriously. Couldn't care less about it. Where's our greatest opportunity and what's the risk? That's the way we'll make our decision.
How do you determine how much you're willing to pay for that?
You look at if it's a turnaround, you look at a discounted value to the net asset value, or if it's a normal business, you look at a multiple of earnings. We do those things. But my point is, do we labor over statistical analysis and financial engineering and all that crap? No, we don't. You know, we don't. And maybe that's what you all study, and I guess that's good. But at the end of the day, we don't do it. You know? Because at the end of the day, the marketplace is going to tell you what the value is. And the owner's going to tell you whether he's going to sell it for that. So what's the matter what your discounted cash flow says? Those are the things that are important. I looked at this business in Vero. It was owned by a family business, and it was a restaurant. And it was failing, but it was a big facility, and it was well known in the community, and everybody loved it. I mean, their memberships loved this place. And the second generation girl wanted to sell it. And I'm in this meeting with her lawyer, and I said, so how much does she want for it? And he said, she wants $10 million for it. Well, how do you base that, you know? What's it based on? And the guy goes, well, she's not a very sophisticated investor. She just wants $10 million. And I literally said to the guy, well, she's sophisticated enough she can count to 10, you know? Why can't she count to 9? It'll make it cheaper, you know? But there was no reason. That's what she wanted. That was what was important to her, $10 million. Now, she ends up selling it for $10 million, and she finances 7 of it. So she only gets 3 in cash. Well, is that a better deal than taking 6 in cash and taking the risk on the next business? So, you know, we do. I don't mean to be flippant on the financial side of it and projections, but it's not what we base decisions on. It really isn't.
Anybody else? Thank you very much.
My pleasure.